Hi, and welcome to today's presentation on the summary of the CARES Act and the various loan programs available within it. I'm Ashley Murphy, Certified Financial Planner, accredited investment fiduciary, founder and principal of Arete Wealth Strategists, a US-based registered investment advisory firm that works with Americans in Australia and Australians in America. Let's get into it, shall we? Okay, so first of all, this is not personal advice. I would encourage you to obtain advice from a professional financial advisor, CPA, tax attorney that can assist you in making decisions about these particular matters. We have thoroughly researched the content, however, so we believe it is of very high quality. Nevertheless, you are instructed to obtain professional advice. Okay, so a little bit about me and my firm. So I'm a tri-citizen, which is what got me interested into this world of cross-border planning, raised in Brisbane. I moved to the US in 2005 after completing undergraduate studies at the University of Queensland. I worked in corporate finance for a couple of years, did my prerequisite examinations, have been involved in a number of financial planning organizations where I've been a speaker. I've also been quoted in the Wall Street Journal. I've been a professor at the University of California, Berkeley and Golden Gate, teaching CFPs as they come through as well. All right. A little bit about Arete Wealth Strategists. Consists of two brands, that being Arete Wealth Strategists, as you would guess, and Arete Wealth Strategists Australia. What's in common to both of these entities is that we're cloud-based, we're fee-only, we're virtual and in-person with a presence in Minneapolis, and right now during this lockdown, it's really exclusively in Minneapolis. I make it out to San Francisco once a quarter, Australia typically once a year, and New York once a year to visit clients in person. All right, so you can see a few more details here about these businesses, and we're really in our sweet spot operating there in the middle. Typical client issues that we address would include the list you see right here. Now, with all that said, let's talk about today's presentation. So first of all, we'll be going through the recovery rebates and how much you might expect to receive from this. We'll be talking about the tax and retirement provisions for individuals, the economic injury disaster loans, the Paycheck protection program, in quite a bit of detail, and lastly, a few other miscellaneous other provisions. So with that, let's get into it. The recovery rebates, what are they? They are a cash payment of $1,200 per individual and $500 per dependent under the age of 17 or 17 and under to help get the economy going back, get on its feet as soon as possible. They are subject to phase outs at different limits, as you'll see in just a moment. We have this infographic courtesy of Michael Kitsis showing the different income levels at which the phase out occurs. You can see for single individuals, it'd be gone at $100,000 of adjusted gross income. And for married filing joint, it's the darker blue numbers. You can see it really begins to go away between $200,000 and about $225,000. But just to ease the calculation there, for the stereotypical nuclear family, two adults, two kids, we'd be looking at a $3,400 payment. It's to be paid as soon as possible to the address and means that the Social Security Administration, that the Treasury Department has on file for you. So if you were to have received your prior refund by means of direct deposit, then you should expect to receive this payment there when it comes through. Just some quick strategies here on how to go about filing or not filing, or delaying, I should say, your taxes for 2020. It's the amount of the payment is calculated based on the most recent information that the IRS has available for you. So if you have not filed your 2019 taxes as of yet, and today's recording is April 10th, you'll know that there has been an extension. Many states, and certainly the federal government's filing deadline until July. So giving taxpayers an additional 3 months to get their taxes in. That being the case, the Treasury Department is looking at the most recent tax return they have on file. If you found yourself in 2019 with significantly higher income than what you did in 2018, where 2019 would disqualify you from the program, then you may choose to refrain from filing your taxes until after your recovery rebate has been paid. There is no clawback provision for this rebate, so that's something to keep in mind. Okay, tax and retirement provisions for individuals. We have seen a new program here allowing up to $100,000 from IRAs or 401ks, 403bs to be distributed. Now, let's be clear in our language. There's loans and there's distributions. A distribution is to say that's just money coming out of your plan with no specific plan to repay it. What's happened here is they've eliminated the typical 10% penalty tax that would apply to those early distributions. But that is not to say that that it's still a good idea, because ordinary income is still applicable. Thus, your 2020 ordinary income would be in addition to whatever distribution you take from your retirement account. And there are a number of other eligible or criteria that one must meet in order to be eligible for this program. So benefits, as you heard me say a moment ago, are eligible, exempt from the 10% early withdrawal penalty, and they can be repaid, but they don't need to be repaid, as you can see here. Okay, so other changes here to loans from qualified plans, that's really to do with 401ks. That's not to say that your 401k offered by your employer even has a loan provision. Most do, but not all are required to. They've doubled the amount of the loan that you're able to take from $50,000 to $100,000 and up to 100% of the vested balance, which used to be up to a max of 50%. Payments on plan otherwise owed may be delayed a year. Note the plans are not required to offer, yes, as you heard me say a moment ago. RMDs, required minimum distributions, have been suspended for 2020. That includes distributions from a range of different plan types, and also for RMDs being taken over the 5-year rule, or even under the new Secure Act 10-year rule. It's essentially as though 2020 doesn't exist. So other provisions relevant to today's presentation in the CARES Act would be a payroll retention tax credit, with greater detail provided here in the resource below from the AICPA, an employer deferment, not to be confused with the employee deferment of the Social Security tax component of payroll taxes, changes to net operating losses, carrybacks and carry forwards, and then other SBA programs would be, deferment of payments for up to 6 months and forgiveness of some current loans. Sorry, forgiveness of up to 6 months of payments on current loans, and forgiveness for borrowers who take certain new SBA loans in the next 6 months, which we'll talk about in just a moment. Other changes have included some healthcare modifications to HSAs, MSAs, and FSAs, where they're now allowing over-the-counter medication and menstrual products to be, those funds can be used for those specific expenses, as well as Medicare beneficiaries being provided with the COVID-19 vaccine when that becomes available. All right. Let's get into it. So here is the meat of the presentation here. So the economic injury disaster loans, this was the first loan program rolled out by the SBA in relation to this COVID-19 crisis. So it's for employees with less than 500 or fewer than 500, sorry, it's for businesses with fewer than 500 employees. Loans of up to $2 million, but these are loans. The only forgivable component here, which we'll see in a moment, is to do with the $10,000 advance prepayment amount. You must have been in operation by January 31st when this loan program went into effect. It's essentially for small business entities or even sole proprietors or 1099 independent contractors. Okay, so here are the loan terms. 3.75% for businesses, 2.75% for nonprofits, maybe up to 30 years. Payments can be deferred for a year. The trick with these loans, however, is that the actual proceeds of the loan have to be spent on very specific things. It's not for expansion or further investment. They are really your typical SBA kind of loan with a few minor modifications is how I would sum it up. What has been tantalizing about this program, which I'll get to in just a moment, is the $10,000 advance prepayment. You can see here what these funds must be used for, and there is some duplication there with the Paycheck Protection Program. As you can see, as I mentioned a moment ago, can't be used for various other refinancing, expansion, growth, or infrastructure improvements. So emergency advances are available up to $10,000, which don't have to be repaid, even if the application is denied, and they are awarded very promptly, which has led some, with those terms and conditions, it's led some to say, well, why don't I just apply for it, even if I don't need it? And that is something for each applicant to ponder. So the Paycheck Protection Program, lots of detail here. This bullet point right here would be my headline of what summarizes the program. It is a short-term program intended to bridge the worst effects of the stay-in-place provisions and the impact that that's wrought on the economy. It is a loan for up to 2 years. That would be for the non-forgivable components, charged at 1%. For 2.5 times the average monthly payroll costs as calculated in 2019 for businesses with fewer than 500 employees, limited to $100,000 per year as that salary cap. There has been talk, and I believe it has been extended, an additional $250 billion that's been applied to this program, given the incredible amount of interest that the banks have received in it. So 2.5 times monthly payroll costs, and we'll define those terms in just a moment. It's run by SBA-approved lenders all over the country. And as you heard me say, it's subject to when the money runs out or by June 30th, these loans must be taken. And it's actually a 2-year loan term, excuse that typo down the bottom there. There have been a number of changes and modifications to this program, given the haste with which it has rolled out. So who's eligible? Let's get specific here. So companies with fewer than 500 employees, unless they're exempted, certain hospitality business and hoteliers would be exempted from that. They can have more than 500, but fewer than 500 or equal to or fewer than 500 in the one location. Also, the employees for whom this is counted must have their principal residence within the United States. That does not exclude businesses that have employees with a principal residence outside of the United States. It would only include those employees. The head count would be only employees with the principal residence in the United States. You heard me mention a moment ago, there is an exception for accommodation and food services businesses. So the business itself has a place of business, not its primary registration, place of business in the United States, and operates here in the US and makes a significant contribution to the US through tax, labor, use of products. This answers a question which we'll see coming up later in the FAQs to do with whether an Australian company with a US subsidiary may be eligible for this program. I've also included a link here in the program, which will be posted to my website. The presentation and the recording of the webinar will be posted to my website, so you'll be able to click on that link right there. So eligibility in greater detail, we go through that right there. One thing to be mentioned is it does look as though 1099 contractors, so independent contractors of a business cannot be included in the payroll calc, because those 1099 contractors would themselves be eligible for the payroll protection plan. Loan limits, $10 million loan limit, which is calculated, as you've heard me said, by the 2019 average eligible payroll costs, which we'll go over in just a moment, just 2.5 times the average monthly eligible component, plus the balance of any economic injury disaster loan being refinanced. Again, another helpful, this is a very, very helpful resource, this one that goes into great detail about that calculation. Okay, so here we have the definition of what that payroll cost actually is. Remember, there's a $100,000 salary cap, and anyone with a non-US principal residence is excluded. For sole proprietors, independent contractors, and self-employed, there is the definition right there. How should you calculate the maximum loan amount? Let's get into that and do an example here. So what you see with this business, note all US residents, here's the annual pay. What we do is we sum all of this up and we arrive at 380. However, this individual is paid over $100,000 a year. So we subtract 50 from that calc, getting us qualifying comp of 330. Monthly 2019, remember this is 2019 numbers, monthly comp of 27,500 multiplied by 2.5, and once that goes away, we'll see that makes this entity eligible for a PPP loan max of 68,750. Lenders will require certification of a number of different things, but that the loan is in fact necessary for the ongoing operation of the business, given the uncertainty of the current environment. Borrowers must use and retain their workers for that 2-month measurement period for the loan forgiveness to take effect, and the borrower has not received a loan for the same expenses. So you can't double up on the same expenses. And here's what the PPP loan proceeds must be used for. Very specific, and if I was working with a client, I would instruct them to have detailed accounting showing that the proceeds are being used for these specific items. So general loan terms, again, there's been subject to a great deal of confusion and modification, but the interest rate is not to exceed 1%. Very liberal underwriting criteria, so no personal guarantees or collateral required, and the payment term would be 2 years for the non-forgiven component, should there be any, of the loan. And repayment wouldn't begin for 6 months after the loan's taken out anyway. Borrower requirements, of course, you're certifying that the statements you're making are true. Okay, so loan forgiveness, got to maintain the same employee levels for that measurement period, and 75% of that loan must be for payroll, with 25% being for other overhead related expenses due to the high anticipated subscription of this particular loan program. Forgivable costs, okay, you heard me, it's kind of all the same things we see above there. And luckily, the discharge debt is non-taxable. So unlike former loans under the TARP program, loan modifications there, if there was a principal reduction, without specific exemption, could be treated as taxable income. There was specific exemption provided for that debt also. But that's important to note. So a frequently asked question, can a private equity or venture capped startup apply for a PPP loan? The answer mostly would be yes, depending on the aggregation rules that are applying. So we need to look at the common control of the owners of that firm, and more than a 50% voting right owner would have that common control calculated. So if they owned multiple companies, then the sum total of all the employees across all the companies would need to be considered to determine whether one particular portfolio company would be eligible for that PPP loan. I've also provided a link here to a document that talks about the common control calculations. Another frequently asked question, which I have already addressed, and that is that due to a change in the loan program, it used to be that they would ask, are you a US citizen or legal permanent resident? Now it's merely, is the US the principal place of residence for all employees of the applicant included in the applicant's payroll calculation above? No is not necessarily a disqualifying factor, but that's okay, because if you can demonstrate that you're spending significant funds and employing individuals in the United States, then it's my understanding from the link that you see here from a lawyer's blog that, in fact, you should be able to qualify for the loan. So in conclusion, as you consider the strategy you're going to employ in applying for this loan, you want to be informed, be engaged, and be realistic about the financing you need. Don't over leverage yourself and expose yourself financially in the event that there's some unforgiven proportion of the loan. So be strategic, understand what these different opportunities are if you're intending on making use of multiple loan programs. In particular, analyze the program risks to understand what you may be on the hook for, and maximize state resources as well. This presentation has been only on US federal loans, so there's plenty of state resources available too. I've looked at loan programs in Minnesota, and there's also an extensive range on offer here as well. So the next week's webinar, which I hope you can join me for, Tuesday, April 14th, is going to be more a broader economic implication discussion for Aussie expats and Americans in Australia. So please join me there, 8:30 Eastern Time, 5:30 Pacific Time. There's the Zoom link right there. Here is a list of general resources for the PPP and the CARES Act. You're welcome to download my key financial data sheet from my webinar, which has Australian and US tax rates involved, stated on that key financial data sheet. Please go visit my website, where you'll find white papers that were published, and there's more in the pipeline now. If you're interested in contacting me and scheduling an appointment, then please do so. Come to my website. That's Arete, ARETE-WA.com, and click on the Get Started tab right there, and we can find a time to talk. Thank you very much for listening to this presentation.